Okay, welcome back. We left off with the trial balance from December. Now we're going to go ahead and make those adjusting journal entries that we were talking about. So the first one that you were given, and remember all adjusting entries will be dated 12/31 or whatever the end of your reporting period is. So all of these would be dated the same. Number 1, the customer who paid in advance had their dog groomed on December 29th. The service was completed for $100. So we're looking back and we realize, hey, wait a minute. We don't have that liability, all of that liability anymore. We've used up some of that unearned revenue of $100, and we now get to recognize that we've completed the service and recognize some revenue. I'm sorry, that should be grooming revenue. So that's going to be $100. Secondly, the telephone bill for November and December was $75. The bill was not received until January 20th. But the matching principle says we need to record it in the period that we used the expense or gave rise to the revenue. So we need to record the expense, but we're not paying it. It's the same if I said, hey, we got the utility bill and we're not going to pay it. We're going to go ahead and credit that accounts payable. A lot of these adjusting entries are going to look exactly like what we do during the normal month. Adjusting entries will never, ever, ever involve cash. Number 3, Jason says Nicholas forgot to write down a service completed on the 24th. So there was a service on account. You need to debit accounts receivable, and you need to credit grooming revenue. Same entry we would have made on the 24th, but we're looking back and going, hey, this got missed. Companies often do billing, and so they don't have that information till the end of the month anyway, so this is a very common adjustment. Number 4, Camille went ahead and counted those supplies, and if you look back, remember we had supplies of $1,000. She counted them and there's only $750 left. So you could just draw a quick T account here, and I started with 1,000. I only have $750 left. Well, I know that if this is all on the debit, I'm going to have to use up something on the credit to make it work. And that's really what I did. I'm going to recognize my supplies expense because I've now used those supplies up. And I'm going to credit my asset supplies because I don't have it anymore. Okay? Or you could simply just take 1,000 minus 750. On number 4, we're told that Camille, that was number 4, I'm sorry. On number 5, assets depreciate at $10,200 per year. You're only adjusting for 2 months. So before we do the numbers, remember when we are showing the allocation of a plant asset over its useful life, we debit an account called depreciation expense. This just is showing the cost of the equipment being used. Now on supplies, notice we credited the asset. But we can't do that with equipment because we're required to keep the equipment on our books at cost. So we set up a new account. It's a contra asset, and it's called accumulated depreciation, in this case equipment. It's going to hold all of the depreciation over the life of the asset. Now how did I get that $170? Well, I took a yearly depreciation, I divided it by 12, and I times it by 2. Okay? When we get into Accounting 202, we'll actually teach you how to calculate that 10,020, but for our purposes, we don't need to do that yet. The key here is this is a contra asset account, so it has a normal credit balance. Moving on to number 6, the employee Brian worked the last 2 weeks of December but was not paid until January 5th. That's pretty common. We get to the end of the year, we have a couple days we haven't paid yet because payday is not until the 5th. So just like during the month, we're going to debit salary expense because that is a cost. But we're not going to write them a check. So we're going to credit salaries payable. Now remember, accounts payable is what we owe our vendors. Salaries payable is going to be what we owe our employees. On number 7, we have interest. Remember, we bought a piece of office equipment, but we need to show the cost of using someone else's money. And when we use someone else's money, we call that interest expense. This is an adjusting entry, so we're not going to pay it today. So we're going to credit interest payable, and it's a very simple calculation. It is the cost of the note of $3,500 times the interest rate of 12% times 2 out of 12 months. So this is going to be $70. Now remember, you could also write it this way, 3,500 times 0.12 times 2/12. Whichever works better for you. And then the very last adjusting entry we were asked to do was rent. Remember, if you look back at our trial balance, we had rent, we had prepaid rent of $1,000 here. Well, we've used up some of that rent. We prepaid for December and January, so we've used 1 month. So we're going to debit rent expense of $500, and we're going to credit prepaid rent of $500 because we've used up that asset. So after you do the adjusting entries, you're going to go through the similar process we've done before. You're going to post all of those to the T accounts. This is what you're going to have. The stuff in blue is the beginning balance. The stuff in green is the December transactions, and the stuff in purple are the adjusting entries. If you need to go ahead and pause here to compare to your answers, please do so. Then you're going to do the December trial balance. So notice the theme here. We do trial balances a lot. And here's what your trial balance is going to look like. It's going to be a list of all the accounts and their balances. I put them in the order of the chart of accounts. So this is what you should have. If you need to pause here, please do so. But that's your trial balance. Now, the next step in the process is going to be doing those financial statements. So let's do the income statement first. We are not going to have a multi-step income statement because we're not selling stuff. So we do our revenue minus our expenses, and we have net income of $167. Then we're going to go into our retained earnings statement and notice that $167 flows here. We had no beginning, but our dividends are going to come into play. And then finally, we're going to do that classified balance sheet. Now, their balance sheet's pretty simple, so there's not a lot of classification, but there is some. So we have our current assets here. Then we have our property, plant, and equipment here. And then this is our total assets. Then we're going to do our liability and stockholders' equity section. And notice this number here comes from the statement of retained earnings. So we have our total current liabilities. Notice unearned revenues here. That is a liability. And more total liabilities and stockholders' equity. We balance, so we are good to go. If you have any questions, please ask those in the discussion board.